Welcome to our deep dive. Today we're digging into the Quantum Corporation fiscal first quarter 2026 earnings call. That happened after hours, September 10th.
Right.
And our mission here is, well, we need to unpack this really significant earnings miss. It's pretty bad.
Yeah, bad is putting it mildly.
And then look at the cost-cutting strategy the new CEO was pushing very aggressively, and why the market reaction was, frankly, so skeptical.
It makes sense, though, the skepticism. I mean, the numbers were just so far off what anyone was expecting.
Totally.
So the market's basically saying, okay, you see the problems, but can you actually fix them this fast? That's the big question mark.
Okay, let's hit those headline numbers right away, because they really set the stage. Non-GAAP EPS. It was a loss of $1.58 per share.
Ooh.
Yeah, and you got to remember, the street was expecting a loss, but like maybe $15 to $70.43 negative.
Right, in that ballpark.
They missed that range by over $1.15. It's a huge miss.
And it wasn't just the bottom line, was it?
No, exactly. The top line revenue came in at $64.3 million.
Which was also short.
Way short. Consensus was around $70.1 million, so nearly a $6 million miss there. And down 9.9% year over year.
So you put those together, missing badly on revenue and a much bigger loss than expected. It just screams trouble, right? Like immediate financial first aid needed.
Definitely. Okay, so let's get into why the financials were so painful. It wasn't just sales being weak, right? There were margin problems too.
That's right. The GAAP gross margin fell to 35.3%. That's down from 37.4% the year before.
And what did management say caused that erosion?
Well, they pointed to a couple of main things. Basically necessary cleanup, it sounds like. First, bigger inventory provisions for some older end-of-life products, clearing out the warehouse.
Got it. Making space for the new stuff, but it costs you now.
Exactly. And second, they got hit with some unexpected import tariffs during the quarter. They mentioned some efficiencies, like in the service org, helped a bit.
But not enough.
Not nearly enough. So when you add it all up, adjusted EBITDA it ballooned to a negative $6.5 million. That's way worse than the negative $2.2 million they posted the year before.
Okay, but here's where this story gets a bit more complex, because even with those rough Q1 results, the new leadership was already making cuts.
Yeah, they're moving fast.
The cost reset, you could actually see some early positive signs. GAAP operating expenses. They actually dropped quite a bit year over year, fell to $35.3 million from nearly $44 million.
And non-GAAP OPEX for the quarter landed at $30 million.
So that's the first sign, right? The new team grabbing the reins on spending.
Absolutely. Ripping costs out immediately. But maybe the biggest move, the most crucial one right away, was stabilizing the balance sheet. They needed cash.
And they got it. Cash and restricted cash jumped way up, $37.5 million. That's compared to just $16.6 million the quarter before. A huge difference.
Critical breathing room.
But where did that cash come from? It wasn't from operations, obviously.
No, definitely not. It came from an existing agreement they had. It's called a Standby Equity Purchase Agreement, or SEPA.
Okay, explain that a bit. A SEPA.
Yeah, think of it like a prearranged deal with an investor. The company basically drew down about $83 million in net proceeds from this SEPA. It lets them sell shares over time to raise cash quickly. It's the lifeline they needed for this turnaround attempt.
And having that cash let them deal with some debt issues.
Exactly. That was key. They paid off their entire revolving credit facility, just paid it down and terminated it.
Taking that short-term risk off the table.
Precisely. It's a big defensive move. Now, they still have term debt, about $104.3 million outstanding. But because of the cash injection, their net debt, which is debt minus cash, dropped by over 40%, down to around $66.8 million.
Wow. Okay. So a really fast financial reset. Cleaning up the balance sheet, getting cash, cutting some OPEX.
Swift and necessary. It buys in time to fix the deeper operational problems.
So let's talk about the new leadership. CEO Hugues Meyrath. He came on board in June, right in the middle of all this. What's the message coming from him?
The message is very direct. He talked about 3 key words: integrity, ownership, and urgency.
When a CEO has to emphasize those.
It kind of tells you something, right?
Yeah.
It suggests maybe those were lacking before. So the stakes are high for the new team. His strategy is pretty clear. Keep cutting costs aggressively, hammer down on sales discipline, fix how they sell, and prioritize paying down that remaining term debt.
Did they give any timeline on the debt?
They actually signaled they expect to talk more about restructuring that term debt before the next earnings call, so soon.
Yeah, and it's not just him. They're refreshing the team, aren't they?
Oh, yeah. Big changes. New chief revenue officer, new VP of Americas sales, and they added two pretty accomplished board members, specialists in supply chain and data protection sales.
Clearly targeting the weak spots they identified, sales and supply chain.
Exactly. But here's the fascinating part, the contradiction, really. The market seems to be almost ignoring the leadership changes for now. All eyes are on the Q2 guidance.
The next quarter. That's the make or break quarter, it sounds like.
That's what management is setting it up as. This is where they have to show the turnaround is starting.
Okay, so what are the numbers for Q2? What are they guiding?
Well, revenue is actually forecast to dip again, sequentially, down to around $61 million, give or take $2 million. So the top line isn't recovering yet.
Still sliding, okay.
But, and this is the crucial part, the bottom line, non-GAAP operating expenses are expected to drop significantly again, down to about $27 million, plus or minus $2 million.
Whoa, hold on. So that's another, what, roughly $3 million sequential cut in non-GAAP OPEX?
That's the plan. Surgical cuts continuing.
But wait a second, how does that work? They're cutting OPEX by another $3 million, but they just hired a new CRO, a new VP of sales.
And they said they need to build out a whole new enterprise channel.
Right. Isn't that cutting directly conflicting with the investment needed to fix the sales problems they just admitted they have?
That is the absolute core tension here. That's what the market is struggling with. Management is basically betting everything on these cuts being so effective, so targeted, that Q2 adjusted EBITDA hits approximately break even.
Break even from negative $6.5 million in Q1.
Exactly. A massive swing. That's the pivot they're promising. And the non-GAAP adjusted net loss per share guidance is much tighter, too. Negative $0.26, plus or minus 10 cents.
So they're prioritizing showing immediate bottom line leverage from the cost cuts, even if the top line is still weak.
That's the bet. They need to nail that break-even number. Absolutely nail it. The market needs to see proof.
Okay, so assuming they stabilize things financially, what's the actual growth story? They can't just cut their way to success forever. Where does the revenue eventually come from?
Good question. The strategic path they outline is about shifting the product mix, focusing on higher value stuff, things aligned with, the big trends, AI and cyber resilience.
Leveraging their data management background for today's problems.
Right, taking their heritage and applying it.
Can you give us specifics? What products are they really pushing?
Okay, first is the DXi platform. Specifically, they highlighted new 1U all-flash DXi T-Series appliances for deduplication. Think fast backup, instant recovery.
Which is critical for ransomware protection, cyber resilience.
Exactly. They offer up to 480 terabytes raw NVMe in just that small 1U box. And they're reminding everyone, hey, we basically invented deduplication. So playing on that history, but for modern needs.
Okay, that makes sense. What else?
The second big push is cold storage. This ties directly into that explosion of data from AI, right?
Yeah.
All that unstructured data needs to go somewhere long-term cheaply.
So tape and object storage.
Yep. They emphasized ActiveScale, their object storage, and their tape libraries, the Scalar i7 Raptor, positioning it as the absolute lowest cost way to handle massive data growth. And they mentioned hyperscalers already use their stuff, which adds credibility.
Any other product notes?
They also mentioned reinvigorating StoreNext, especially pushing an Ethernet IP version that the channel partners in media entertainment have been asking for. So shoring up their traditional base, too.
Okay, the products sound relevant. DXi for speed, cold storage for AI scale, StoreNext for the base. But the Q1 miss looms large. It feels like they can design decent products but struggle to actually sell them effectively.
And the CEO basically admitted as much. His comments laid out a whole list of execution failures.
Like what?
Fundamental stuff. Weak lead generation, poor conversion processes, sales comp plans that weren't driving the right behavior, and critically, not having a real enterprise channel to sell DXi outside of their usual media vertical.
So they built good tech, but couldn't get it in front of the biggest potential buyers.
Pretty much sums it up. They weren't structured to sell their best products into the largest markets.
Which brings us back to the investor reaction. The stock dropped, 17% right after the call?
Yeah, a sharp drop. And the overall feeling is still just deeply cautious. That Q1 miss was just too big. It shook confidence badly.
So the cost cuts are nice, but
they're overshadowed by this huge execution risk. The market is essentially saying, show me, don't tell me. They need proof, actual results showing the new team can fix sales while cutting costs. It's a tough balancing act.
All right, that sets us up perfectly for our segment. This is not financial advice. Just a reminder, we're analyzing the data, talking about market dynamics. This is purely for education and observation, definitely not telling you what to trade.
Absolutely. But given this setup, The huge Q1 failure clashing directly with this really aggressive Q2 break-even promise, it does create an interesting, let's say, hypothetical trade scenario.
Okay, let's hear it. What's the outrageous but plausible idea based on this Q2 binary outcome?
Okay, so the trade idea, keeping in mind this is high risk, would be something like an aggressive, short-duration call spread.
A call spread. Betting on the price going up, but capping the upside and lowering the cost.
Exactly. You're making a directional bet specifically on the new CEO pulling off this Q2 turnaround in just 90 days.
What makes it plausible, even slightly?
The plausibility comes from that $83 million cash injection. That SEPA money gives them runway. It's real cash. And if they hit that break-even EBITDA in Q2.
The narrative changes completely.
Overnight. It proves they can generate operating leverage, even with revenue still falling. It validates the cost-cut strategy, at least initially.
Okay, that's the plausibility. Now, what makes this specific bet outrageous?
The outrageousness is the sheer precision required. You're betting on flawless execution. That the new CEO and his just-assembled team can cut exactly $3 million in sequential non-GAAP OPEX.
While juggling a new sales strategy, new sales leaders, new board members.
Without causing even more disruption to the business, it's a ridiculously tight timeline, 90 days. If they miss that break-even target, even by a little.
It suggests the problems are maybe even deeper than they're letting on.
Exactly. So it becomes this pure high-stakes bet on the CEO's ability to walk this incredibly fine tightrope over the next 3 months. Failure could be pretty ugly.
Wow. A very clear, very binary setup focused entirely on that one number. Q2, breakeven EBITDA. Okay, let's wrap this up with the key takeaways for you, the listener.
Right. So number one, a really painful Q1 miss on both revenue and earnings. No way around that.
But number two, management reacted incredibly fast with the financial reset, got cash via the SEPA, cut net debt significantly, started aggressive cost cuts.
Which all leads to number three, this critical Q2 guidance hinging entirely on hitting that break-even adjusted EBITDA target.
Okay, so that leaves us with the final provocative thought, the question to mull over until the next report.
And it really boils down to this fundamental tension. Will the deep cost cuts, which are good for the bottom line right now, end up choking off the investment and effort needed in sales and channel building, which are absolutely essential to stabilize revenue long term?
Which force wins out in the next 90 days? Cost control or the push for sales recovery?
That balance, or maybe imbalance, between cutting costs and investing for future growth, that's the entire story here. Which lever proves stronger next quarter? That's what we'll be watching.
A perfect question to end on. Thanks for tuning into this deep dive.